Welcome to the StockOptionAssassin.com's free video for swing trading options. My name is Eric and we are back. I just want to let you know over the past several weeks, as you probably noticed, we haven't done any free content. What we've been doing is we've upgraded our membership site for the MTS. We've added some more trading video series. We have our Momentum Sniper course, our Credit Spread Crash course, and we also have a Counter Spread course that's part of the MTS service. And that's kind of what we've been focused on. But now that we've kind of got that under control and everything is going smoothly, I'm going to start up the free videos. And if you're interested in trading with us, please go to the website at StockOptionAssassin.com and click on the Trade With Us tab for more information. So again, let's get back to our free video for today. And we're going to take a look at a chart of gold. And I want to do a couple things. First of all, I want to talk a little bit about the overall market and gold. And I want to talk about how we traded gold. We're actually still in this play, and talk a little bit about credit spread. So that's kind of what we're going to look at. So first of all, the markets over the past few weeks, there's the debt ceiling scare. The market dipped, it came back up. Let's take a quick look at the SPY. The market, came down here, dipped, and now it's rallying back up. And actually, there's hope of a Washington deal that's happening. I think they do get a deal. I think we ride up to the top of this bigger channel here, and at that point, it's anyone's guess because it depends on what the deal is. If the deal in Washington is sort of temporary, then it's more likely we stay range bound. And what we're going to want to maybe do is once we get up to these levels, if we get up there, start looking at bear call spreads for November. Right now, we have about 32 days left in November, and so it's a good time to start thinking about selling spreads. Because as the market sort of consolidates or pulls back, the theta is is the fastest, or the time decay is greater in the last 20 to 30 days of the options expiration. So that's overall, we're in the service, we're kind of waiting on that deal. We've got a couple long plays. We're long Starbucks and Halliburton right now. Those are working out well. But I want to shift our focus to gold, in particular the GLD, and kind of how we played this. So first of all, gold was sort of seen as a safe haven and kind of got these pops. And then once it started, coming out that there could be a deal, gold basically fell off. And this is to be expected. Right now, gold is the fear trade, and the fear is slowly subsiding because they think Washington's going to get some sort of deal. Now, due to the uncertainty of this deal, we decided not to strictly buy puts on it. Although hindsight, we entered right here on the 9th. Hindsight, obviously, if we bought puts on the 9th, we would have made a ton of money 2 days later. But we decided to go with a bear call spread where we sold the November 129 calls. We bought the 133 calls for protection, so we have a $4 wide strike spread, and we got about $1.13 credit. So all we're looking for gold to do over the next several weeks is basically just stay below 129, and we'll collect most or all of our credit. So that's kind of the play that we're in. So I wanted to take a little bit of time and just talk about intrinsic versus extrinsic value and why we would sell the bear called spread. So first of all, gold had been obviously in a downtrend. We're trading below the moving averages, and here I have a 13 EMA, a 20 simple, and a 50 simple. And we're trading. We're obviously in a downtrend. There's lower lows, lower highs, that kind of thing. We're below the moving averages, and the squeeze indicator is below zero. And then right on this day was when it kind of signaled to us, okay, you know what? This thing could really move lower. We entered into our spread. The next day, the squeeze fired off, and now we're into a multiple day downtrend. And I think actually gold can go much lower. I'm actually looking for a target of 115. At that point, you probably get some sort of bounce off that. Could it go even lower? It's actually very possible because you do have a Fed-backed market, and with the Fed still backing the market, then stock prices are likely to go higher. But we need to get past this sort of Washington stuff first, and we'll see what happens. But so anyway, gold, we think is going lower, or is at least not going to be going higher, which is why we sold that bear call spread. So let's quickly go into the option chain for the GLD. And I want to talk a little bit about intrinsic and extrinsic value. And this is something we cover in our credit spread course, but I think I can touch on it real quick here. So I'm in the option chain. We're looking at the November options for gold. And I'm going to drop this down. I have a delta, intrinsic, extrinsic. So right now gold is trading at 122.80, so just below 123. And you can see in here that the intrinsic, extrinsic value will be listed for each strike price. So right now you can see anything above 123 above, these are all out of the money, and the intrinsic value is 0. So these are the options you want to sell, with the idea that if you sell something that has some sort of value, eventually this would go to 0 as long as gold stays below, at this point, 123. Now we sold the 129 spread, so you can see if I go, I'm going to put on here, I'm going to go deep and wide. We sold a 1 month 4 strike vertical, and we sold the 129 133 call spread. We sold it for $1.13. Right now it's trading for about 60 cents, but still the intrinsic value of this spread is actually still 0. So as long as gold stays below 129, this spread, as you know, and the other spreads would actually eventually go to 0. So the strike that you sell needs to, the stock needs to stay below that. So that's just a little something on intrinsic, extrinsic value, how you can kind of see that in Thinkorswim, and why we would sell an out of the money spread. So this is the strategy we're using on GLD. Let's see if Washington can get their act together. If they do, I think gold's going to go much lower, and we would look to either buy this spread back in a few weeks for much cheaper, or if the market really gets going, then we would just let this expire worthless. So that's it for this video. Sorry for the delay in the free videos, but we're going to start getting those back going for you. If you have any questions, feel free to send us an email, and you guys have a great day.